Hello, everyone. Thank you all for the well wishes. I'm feeling a lot better this week than I was feeling last week, so thank you for that. This is week 2 of our virtual learning environment. We're going to be going over the chapter 18 PowerPoint, and the way this works is going to be a little different than the last PowerPoint that we did. Last time, all you had to do was comment saying, hey, I watched the video, and if you had any questions, you could have asked. This time, I'll be asking a few questions throughout the PowerPoint, and just pick one of those questions to answer, and that would be what you would write into your discussion at the bottom. They're really easy, and I'll have several of them throughout the PowerPoint, so you can pick which one you want. All right, so let's begin. We're going to go over chapter 18. I would also like you to be aware of the fact that this video is only going to be going over half of chapter 18, because in class normally what we would be doing is going over half of it on Monday and then the other half of it on Wednesdays. So I'm trying to really mimic what we would be doing in class anyway. So I'll have another video with the second half of this PowerPoint. Okay, so here's the chapter 18 PowerPoint. Chapter 18 is on managerial accounting concepts and principles. So the different topics we're going to talk about is just managerial accounting as an overview, some basic concepts about that. And what this chapter does is it really combines managerial accounting along with cost accounting. Cost accounting is accounting for companies that manufacture a product. So we're really talking about managerial accounting here along with manufacturing type accounting for those types of companies. We're also going to be talking about financial statements for those manufacturing companies, and then we're going to bring it back to more managerial concepts with some trends that are going on in accounting and in business as a whole.
There are 4 kinds of business: tourism, food service, railroads, and sales, and hospitals/manufacturing, and air travel.
Okay, so for the first slide, it's really just some basic information on managerial accounting. So it helps provide financial and non-financial information for managers and for other decision makers. So really we're focusing on a couple things here. One is that it's non-financial and financial information. So it could be things that don't have monetary value, like customer satisfaction, are our customers happy with our product and our service? That's a non-financial measure, but it's really important for managers. The other point that we're trying to make here is that this is for managers, not for investors, not for outside or external sources. This is really for the people who work within the company and how they're going to use this information to make decisions. All right, so it helps in the management functions of planning and controlling. There's about 5 basic management functions. So really what managerial accounting does is help management plan and control for the future. Okay, it helps them answer certain questions like, should we develop a new product or expand into new markets? Should we build a new factory? Are costs too high? Is our supplies, are they adequate? Are we getting good quality items? Are we making money? And like I said before, are customers satisfied with our service? So it answers these questions and many more questions that management might have in order to make a decision for the business. All right, so I really like this slide. This is basically the differences between managerial accounting and financial accounting. So financial accounting is basically what we've been doing this whole time up until this point. Managerial accounting is really what we're going to focus on for the next few chapters. So like I said, I like this slide because it really does highlight the differences between what you've been doing and what we're going to be doing now. So financial accounting is really for the external users, for investors, for creditors, for anyone to use this information, mostly people on the outside. And like I said before, managerial accounting is mostly for those who are internal. So those who are in management, those who work for the company. Right, so the purpose of information. So for financial accounting, it helps those external users make decisions about the company. Should we invest? Should we give them a loan? Managerial accounting helps the managers make decisions within the company. They can plan accordingly, they can buy new products, they can open new locations, new factories, that type of thing. right? The flexibility of reporting. So financial accounting, we had to follow GAAP rules. At least all the public companies have to do that. Now, managerial accounting is much more flexible. Since it's only for inside the company, there aren't specific rules that they have to follow. They just need to make reports that meet their needs. Timeliness of information. So we usually have the reports every time after an audit is complete. So that's like the 10K statements you had to look up for your project. That was done after the audit was complete, and then it's available for the public. With managerial accounting, we can get those reports whenever we want because it's not specific reports. It could kind of be anything that they want. So you can make these reports every day, every week, every month, and anything you want on them can be on them. For financial accounting, we always look at historical information, so what happened in the past year, and we'll report on that. Managerial accounting, they do look at what happened in the past, but they use that to make predictions for the future. All right, the focus on information for financial accounting is the whole organization, but with managerial accounting, we can look at just specific areas, specific divisions. We don't have to look at the whole company. If we just want to look at information for our one factory, we can do that. We don't have to look at what human resources is doing and what their numbers are. So we really can focus on information that's meaningful. Financial accounting is monetary information, so everything is in terms of dollars, where managerial accounting, it's both monetary and non-monetary. So kind of like what I was saying in the beginning, where it could be information that's not financial. So like customer satisfaction is the main one. All right, so this next slide, we're going to be talking about different product costs. There are going to be 3 types of product costs that we're going to be discussing. The first one is direct materials, and we have direct labor, and then we have overhead. So we can call it factory overhead, manufacturing overhead, or just overhead. So these are the 3 main topics that we're going to be covering, and I'm going over each one of them individually. Okay, so first we're going to talk about the direct costs. So this includes the direct labor and the direct material. So direct labor is the wages and salaries that are separately and readily traced through the manufacturing process to finished goods. So basically, this is the labor, so the workers, what we pay them, their expense, their salary, their wages. It's those who work directly on the product. They're the ones who are actually putting it together. So we can actually tell how much something costs to make. You know, so if something takes an hour to make and I know I pay you $10 an hour, I know in labor it costs me $10. So like I said, these are the people who actually work on the product. So assembly line workers or those putting it together. It wouldn't include management or security or the cleaning staff, just those who actually work on it. So they're direct labor. It's a labor directly related to the product. So the other one was direct materials. Same type of concept. It's the materials directly related to the product. So let's say that we are manufacturing a car. What would the direct materials for that be? So one example would be the tires. We need tires to go on the car. So here's your first question that you can answer. What would some other direct materials be for manufacturing a car? Okay, so next we're going to be talking about overhead. Overhead is basically like a default category for everything else. So if something is not direct labor and not direct material, it's going to go into the overhead. And remember, this is called factory overhead or manufacturing overhead. So the first item would be indirect materials can go in here. So these are materials that maybe don't end up in the finished product. They're not physically part of it, or they're so insignificant that it's hard to even put a cost on what we're spending. So think about, making a car, maybe thread that goes into the seat cushions. That'd be something that's hard to put a cost on. So it's usually just the main things would be the direct materials, the insignificant parts that don't cost a lot or don't end up in the finished product. They would not be considered direct materials. They would be considered indirect. Okay, so indirect labor, same concept. So basically, the direct labor are the employees who work directly on the product themselves. So the indirect labor would be everyone else. It could be management, it could be the security staff, the cleaning crew, anyone else who works for the company but not directly on the product. Okay. And also, like I said, all other costs associated with the factory itself. So what they spend on utilities, so the electricity, the heat, the water, what they spend on rent or insurance, just anything else that is a cost, it's an expense related to the factory would go here into overhead. So, as a summary, we have direct material, direct labor, and then overhead, everything else. Okay, so all manufacturing costs that are not direct material and not direct labor, and that cannot be separately and specifically traced to the goods that we're producing. All right, so another type of cost that companies may have is what's called period costs. Period costs are costs that do not have to do with manufacturing the product. So these are other costs that a business may have, but they have nothing to do with making the actual product. It has to do with selling and administrative type costs. So first we have selling costs. So all the money we're spending, all the expenses we have on selling the product. So let's say we have a manufacturing plant that makes a product, and then we send it to a store that sells the product. So we have the manufacturing costs related to the factory, and then we have selling costs. These would be the period costs related to selling the product. So anything related to the store, the salaries of the people who work there, the rent for the store, the insurance for the store, anything related to the store would be considered a period cost. So just make sure you have these two separated. We have the product costs, direct material, labor, overhead. Period costs, they do not have to do with the factory. So we got selling and also administrative costs. So this would include the accountants, us, right? Lawyers, human resources, just anyone who works in an office outside of the factory itself. So period costs are just other costs a company has that are not related to making the product. Okay, the next question that you can answer as part of the discussion is, where do you work and what's your job function? And then to add to that, your wages that you get paid, would that be considered a product cost? If so, would it be direct labor or would it be part of overhead? If not, is it a period cost? If so, would it be a selling cost or administrative cost at your job specifically? Okay, so we're going to be working on the classwork problem, so make sure you have the Word document downloaded so you can follow along as we do this. This is classwork problem number 1. Okay, we have DS Company that produces sporting equipment. Specifically, we're going to be talking about producing footballs here. So we're going to have to identify if the cost would be considered direct material, direct labor, overhead, or a period cost, meaning it has nothing to do with the factory itself. The first one we have is electricity used in the production plant. I always ask myself the question, does it have to do with the factory or not? In this case, electricity used in the production plant, it's definitely being used in the factory. The direct materials, direct labor, and overhead, these ones right here, all have to do with the factory. Okay, so it's going to be one of these three. Now, is electricity, is that a direct material? No. Is it labor? No. So then by default, everything else will be going into factory overhead. I'm just going to write factory overhead right here. Factory overhead. Okay. Number 2, labor used on football production line. Remember that labor doesn't always have to be direct labor. It depends if you're physically working on the product or not. Also, if it has to do with the factory or not. In this case, it does have to do with the factory because it's the production line. So what do you think it would be? It would be direct labor because you're actually working on the product. DL. Next, number 3, we have sales commissions. This is paying the employees, the ones that work in the store, the commissions for selling the product. Would this be a factory cost? No, because it has nothing to do with the factory. So if it doesn't have anything to do with the factory, it would be a period cost or period expense. So I'll put PC for period cost. Number 4, depreciation on equipment used to produce footballs. Does this have to do with the factory? Well, it's about producing the footballs. The answer would be yes, it has to do with the factory. Which one would it be? We have direct materials, direct labor, or overhead. Well, depreciation is not a material, it is not labor, so it'll be factory overhead. By default, everything else just goes in there, all other factory expenses. Number 5, salary of the manager who supervises the entire plant. Does it have to do with the factory? Yes, so it's going to be one of these three. Now, it's a salary, so it would either be direct labor or overhead, but it's someone who's a manager who supervises everything. Are they directly working on the product? No, managers do a lot of other things. They manage the whole thing, they put out reports, but they're usually not the ones on the front line working for the company. So this would be factory overhead. So please just take a note that managers are not direct labor, they're considered overhead. Okay. Number 6, office manager salary. So we're talking about managers again, but in this case, it's for the office. Does an office have anything to do with producing the footballs? No, right? So it's not a factory cost. This would be a period cost because it has nothing to do with the actual plant, period cost. Number 7, rent on factory building. Does it have to do with the factory? Yes, it has the word factory in it. So we know it's one of these three. Okay, now it's the rent. Is that a direct material? No. Is that labor? No. Then it would be factory overhead. Delivery expenses. Delivery expenses would be delivering the product to customers. Does this have anything to do with making the product? No, it does not. It has to do with what happens after we make the product. So it would not be any of these product costs. It would be the period cost. Number 9, leather used to produce footballs. Does this have to do with the factory and making it? Yes, it does. So we know it's going to be one of the 3 product costs. Is it a direct material? Well, it is a material, right? It's leather used to make the footballs. Now, would it be direct or indirect? My question is, if we're making a football, how important is the leather to the product? Imagine a football without the leather. It really wouldn't be a football. This material is directly related to the product and is a major part of it. In this case, it would be direct material. Lastly, we have indirect materials used in making the goods. We know that it's used in making the product. It's going to be a product cost, but it's indirect materials. So it's not going to be the direct one. All indirect costs go to factory overhead. I hope you're able to follow along with this and that you understand all the answers to this. Okay. Next, we're going to be talking about the different financial statements for manufacturing companies. The balance sheet for manufacturing companies is very similar to the balance sheet that you've been doing this whole time. The only difference really is the inventory account on it. Everything else is the same. Therefore, we're only going to be looking at the inventory account and how that is different compared to what you've been doing. The first item is raw materials. We're still going to have the inventory account. It's just going to be broken down by these 3 items. Raw materials is the first one. These are materials that are waiting to be used in the product. We have not started working on it yet. It's just the supplies we need to make it. Next, we have work in process, or we better known as what's called WIP, W-I-P, WIP. This is the product that we're making, and it's partially complete at the time of counting our inventory. It's inventory that we have started making, it's just not quite finished yet. The third category of inventory would be the stuff that's done. This is called finished goods. So we have completed products for sale. Everything on the balance sheet would be the same. We still have our assets, our liabilities, and our equity section. The only difference is inventory in our assets section will be broken up between these 3 accounts: raw materials, WIP, and finished goods. A third question that you could possibly answer for your discussion comments would be, think of a product that has to be manufactured. What is that product? And what would the raw materials for that product be? Think of a few. Next, we'll talk about the cost of goods manufactured schedule. This schedule is very similar to what an income statement would be. Basically, instead of having all of the expenses related to the factory on the income statement, we're going to put all of these expenses on a separate schedule, cost of goods manufactured schedule. It's going to list all the factory expenses. We're going to total it up, and the total of all those expenses will then be carried over to the income statement. This makes things a lot neater and organized. Instead of having all the expenses listed on the income statement, we'll have a separate schedule with just the manufacturing factory costs. What goes on it, we start off with the product costs, the ones that we just went over. So we have the direct materials, the direct labor, and the overhead. When you add this up, this is your total manufacturing costs. So all these expenses will go on there, as well as our beginning WIP, the work in process, minus the ending WIP. So it basically just shows us how our WIP has changed over the year from what we started with and what we ended with. So we're going to add that to it. So we take all of our product costs, material, labor, and overhead, add what our work in process balance was at the beginning of the year, minus what it was at the end of the year. This will give us our total cost of goods manufactured. And like I said, we're going to use this number to carry over onto the income statement. Which brings us to the income statement. Once again, the income statement is the same that you've been doing through all the other chapters up until this point. It's going to be looking like how a merchandiser would have it, by having sales minus cost of goods sold equaling our gross profit. Right? Remember that cost of goods sold is an expense. We kind of just pull it out from the other expenses to find where our gross profit is. And then we're going to subtract all other expenses and add any other revenues not related to the operations. That will give us our net income. This is all still the same. The only difference is going to be cost of goods sold. So cost of goods sold is going to change slightly compared to what you've done in the past in accounting 1. Instead of just putting a number, here's your cost of goods sold, we're going to break it down by what makes up cost of goods sold. What we have is our beginning finished goods inventory. This is our finished goods inventory from the beginning of the year. We're going to add cost of goods manufactured. Remember, this comes from the cost of goods manufactured schedule on the previous slide. This is all of our manufacturing costs. When we add that together, we get the goods available for sale. We'll then subtract our finished goods ending inventory from the end of the year. This will give us our cost of goods sold. Now, in summary, the income statement is the same, except cost of goods sold will just be split up and it'll show the full picture on what is going on with it. Instead of just putting it on one line, it will be very detailed like this. We will now be going over a few practice problems that relate to the financial statements we just went over. Please follow along with the classwork handout. Number 2, compute the total manufacturing cost for a manufacturer with the following information for the month. It gives us account numbers. So we got direct materials, direct labor, factory supervisor salary, salesperson commissions, depreciation for the factory and for delivery equipment, and also indirect materials. We want to know what total manufacturing costs are. To do this, we need to find what the 3 main product costs are. This would be direct materials, direct labor, and overhead. Some of this is pretty easy to do. Some of it takes a little bit more thinking. We have direct material, direct labor, and factory overhead. Take a moment to look through the different accounts along with their amounts. Which one would be direct materials? It would be the first one. Direct materials used, $53,750. Take a moment to look through the accounts and find which one would be direct labor. It would be the second line, direct labor used. C part of this is pretty easy, 12,000. Factory overhead's a little bit more complicated. There are a lot of things that go into factory overhead. Factory supervisor salary is next. Would that be considered factory overhead? Yes, it would. It has to do with the factory, so the 8,000 would be included. What about salesperson commissions? That is not part of the factory, so that number is not part of overhead. Remember, that is a period cost. Depreciation on the factory building has to do with the factory, right? So yes, this one here would be part of overhead. Depreciation on delivery equipment. Remember, delivery equipment has to do with selling the product. So this would not be part of overhead. Lastly, indirect materials. Is that part of factory overhead? Yes, it is. So factory overhead will consist of these three numbers here. I just totaled the three up and it came to 12,750. Now add all three of them up and this would be your total manufacturing costs. I got 78,500. My total manufacturing cost, 78,500. Okay. Next, we have problem number 3 on the classwork page. Compute cost of goods sold using the following information. We have finished goods inventory at the beginning of the year, cost of goods manufactured, and finished goods inventory at the end of the year. As a reminder, cost of goods sold is your finished goods inventory at the beginning of the year, plus your cost of goods manufactured. That will equal goods available for sale, minus your finished goods inventory at the end of the year. I recommend pausing this, trying to fill out this classwork problem number 3, see if you get the same answer that we get as we do this together. The first item was the finished goods inventory, the beginning balance. We're going to take that and add that to the cost of goods manufactured. Let's write this in. I'm just going to abbreviate finished goods and a little b for beginning. I'm not going to write the whole thing out. And that's 500. This is pretty easy. All the numbers are given to you. Like I said, we're going to add cost of goods manufactured to that number. Cost of goods manufactured of 4,000. When we add these together, this equals our goods available for sale. I'm just going to abbreviate goods available for sale, only because it's hard for me to write with this. 500 plus 4,000 is 4,500. The last step is to subtract the finished goods inventory ending balance from this. So we'll take the finished goods balance, comma, E for ending, the end of the year balance. It's 750, so we're going to subtract this number. Take out your calculators and do the math. We have 4,500 minus 750. What did you get? It should be 3,750. Next up, we have the next classwork problem, number 4. Prepare the 2017 schedule of cost of goods manufactured for Bar & Company. We want to do the cost of goods manufactured for this one here. Remember, for this one, we need to add up all of our product costs, our materials, our labor, our overhead. We want to add our WIP from the beginning of the year, then subtract our WIP from the end of the year. As a reminder, this is what it looks like. Our material, labor, overhead equals our total manufacturing costs plus WIP at the beginning of the year minus WIP at the end of the year. Our three product costs, direct materials, direct labor, and overhead. We're going to add all three of these together. Direct material, direct labor, and factory overhead. I'm going to keep the amounts the same. We have 190,500 for direct materials. Direct labor is 63,150. And the factory overhead is 24,000. Add these three numbers up to get your total manufacturing costs. You should have got the number 277,650. Next, we will add our work in process from the beginning of the year. WIP, the little B for beginning. That's the 157,600. We're actually going to add this number to our total product costs to get the total cost of work in process. When you add those two numbers together, you should get 435,250. Lastly, we subtract the work in process at the end of the year. So we're going to subtract WIP from the end of the year, which is 142,750. This will give us our cost of goods manufactured. Remember, this also then appears on the income statement. So when I subtract these, you get 292,500. 292,500. That should be your answer. This concludes this half of the PowerPoint for Chapter 18. For Wednesday's class, we will be going over the other half of this PowerPoint. Make sure you click reply below and comment on one of the three questions that I had asked throughout the PowerPoint. Thank you.